Welcome to the daily update where I'll go over the action in the market for Tuesday, February 11th, and we'll see how things look for Wednesday, February 12th. Kind of a sleepy day, still looking positive, but not an awful lot of conviction as we continue to deal with a non-trending environment. The sleepy day could probably be attributed to the anticipation for CPI coming out in Wednesday's session. There's a lot of anticipation about that. But last Friday, we had the employment situation report, which is the most important report of the month, and volume was really dropping off in that session. Are we going to get some more clarity in Wednesday's session just to see, okay, is inflation picking up? Is it going down? Is that going to change our overall scenario for what the Fed may do? There's opinions on both sides. Some people think inflation's really going to pick up. Other people think it's going to go down. We'll just watch the information as it is released. Okay, so right at the open, we had a lower open right at S1 at 60.50. That's kind of the line in the sand right now. Of course, we're dealing with the 6,000 level to the downside and 6,100 to the upside as far as broader term support and resistance. And we went down right to about the middle point. But then we were able to climb back above the daily pivot at 6,062. We hit resistance at the unchanged level, which is a built-in resistance or support level that happens each day. And then we declined back down to S1. Prices then were able to kind of chop their way back up to the unchanged level, but they didn't get above R1. So we did go positive there. And R1 was at 6,078, and then we declined down from that R1 level to close slightly positive. We were up 0.03%, virtually unchanged, but it goes in the books as a positive day. We were below average with volume, so that's where we're kind of seeing some let's wait and see for CPI. And we are still positive when you look at the moving averages in the short, intermediate, and long term. We're seeing some things that are holding up fairly well, other areas of weakness, not an awful lot of conviction right now. And we'll get another read on inflation in Wednesday's session, and that'll have an impact on interest rates. And then all the different things going on with the tariffs and the executive orders and one side saying, oh, this is great and wonderful. The other side saying, oh, no, it's a constitutional crisis. So, it's part of the news cycle that happens these days. Okay, so some comments. It was a choppy day that really lacked any kind of conviction. Could kind of say it's a little more positive since we opened lower and ended up closing a bit higher. And then twice a year, the chairperson of the Fed has to testify before Congress. And the first day was on Tuesday. And the takeaway from that is that Fed Chair Powell said that there's really no hurry to adjust the policy stance. But that's what we've heard before. So there's really no change there. There'll be a second day of this testimony on Wednesday, but probably not watched as closely because he'll be saying the same thing. One day he goes before the Senate, the other day he goes before the House, the committees that he has to report to, and his comments will be the same. The only thing that might be a little bit different is the Q&A session to see if anything slips out at that point. And President Trump did impose 25% tariffs on steel and aluminum, which will go into effect on March 12th, with the possibility that Australia may get an exemption. The 10-year yield is back above 4.5% now, and that's pressuring things and causing a little bit of a concern. So we'll just keep an eye on that. I'm still watching an intraday chart of that. Now, on a short-term basis, our smart money indicators are still looking pretty good, except for one of them. The accumulation distribution, that's looking solid, maybe a little too solid. The chicken money flow, solid, maybe a little too solid. The one that's really not showing much improvement is the chicken oscillator, and that one's actually going down. So we're seeing a bit of a confirmation or contradiction here, and I'll show you the charts of these. No change to the scenario right now. We'll see if that changes after Wednesday's session. The dollar was down and interest rates were up. We're at 4.54% with the 10-year yield, where we had been just under that 4.5% level at 4.49 after Monday. Sentiment didn't change either. We're at neutral, where we're getting a reading of 46, where we had been getting 46 after Monday. We're still not trending, but we're positive. The lines are pretty much on top of each other, but the green line's just barely above the red line right now. That's why it's giving us a positive reading. But the ADX continues to drop. It's below its moving average. It's below 20. And so even though we had the slight up day, I'm keeping the bias at mixed because there just wasn't any conviction. And I've got the momentum at mixed right now too, because we're just not really showing any conviction. There's no trend right now. And we'll just have to see if we're going to break to the upside or break to the downside. We did get one report that came out on the economic front, the NFIB Small Business Optimism Survey. It dropped to 102.8, where the last reading was at 105.1. So here's a chart showing this where it had been showing improvement, and then in the latest reading, it's coming down. Then this is what we look at as far as I look at the average and the median down here at the bottom. What if we break below the December low? And these are all the years when that happened. And then what were the returns for the full year at that point? So this is suggesting, okay, maybe things aren't looking all that good. But then there's other data that I'll be showing you in a little while that says, well, if January's up, the whole year tends to be up too. Then the bottom up consensus, that means they're actually looking at the stocks and looking at their earnings basically first and then coming to their conclusion instead of a top down approach, which uses a different method. It expects a narrower Magnificent Seven against the rest of the S&P 500 stocks as far as earnings going out. So we've already had 2023 where they just blew everything out of the water, and 2024, which is looking good, but then they're expecting that to really drop off in 2025 and then possibly picking up in 2026. So they're still positive and they're still outperforming the rest of the S&P, but they are really dropping down as far as the Magnificent Seven stocks. Then central bank gold demand surged fivefold, 5 times, since the freezing of Russia's central bank assets. Okay, so it just means when we have upheaval like this, gold is kind of the go-to asset that people are going to, and central banks as well. And then this also looks at the Magnificent Seven. What are they going to be spending as far as capital expenditures? And that's expected to go up. And a lot of this is going into AI. And this could actually be good for the economy because they're putting money back into their businesses, which help them grow, but it could have some impact on their earnings. Then where are the sector fund flows? Still, most of the money going into tech. The risk appetite indicator, it's been elevated since the beginning of the year. I guess when we get above the zero line, that means elevated. And folks are still anticipating positive things for the stock market. And we've been hanging in there, staying positive for right now. We just are not trending right now and not showing an awful lot of conviction. And then gold rises to fresh record after tariffs on steel and aluminum. So it's helping, usually it helps the dollar, but the dollar was down in Tuesday's session. But things like gold, that has a tendency to go up as well. The cumulative change in the earnings estimates for the Magnificent Seven coming down a little bit, but still, these are the high flyers now, up 18%, where we're actually dropping a little bit negative when you look at the S&P as a whole, and we're down 5% here with the rest of the S&P. Then the equity risk premium, this is how much are you compensated for by owning stock. It's still giving us a very, very low reading here. Then equity flows have picked back up even more into 2025. This is US. Most of the money is going into the US market. Then you have developing markets when you take out the US. That's the light blue line here. And we're actually seeing a little bit of money coming out of the emerging markets right now. Then a couple of interesting charts here. We've got CPI coming out, and these are all the banks, what they in different places that like to forecast this. I guess these are all banks. The headline CPI and then the core CPI. This is the inflation component right here. And this comes up with the median forecast of what they are expecting. And then, what's the biggest risk to U.S. exceptionalism? This new theme coming back, "Make America Great Again," and all that stuff. What's going to get in the way of that? Well, a lot of people think it's the current administration, but it could be inflation that is just not coming down, could end up having a real impact, at least according to this survey by Goldman Sachs. And here is from Market Watch showing what are they looking at for the median for the CPI year over year and all the different levels. So we'll just be watching this. And it's not so much what the actual headline number is, it's does it come in above or below what the market is expecting? And then the reactions following tariff announcements, and usually they tend to be negative. So that's why we're seeing a little bit of a drain. This goes back to 2018 and 2019. So it's a little bit more recent as to what the impact actually is. And then looking at the intraday chart, we did have a lower open. We opened right about at S1 here and just kind of stabilized sideways. We tried to go up, but then hit the unchanged level, came back down to S1 again, and then we're able to kind of chop our way back up. The daily pivot was acting as resistance there for a little bit. And then we actually broke through and got positive. Then we went negative. Then we went positive. We never made it up to R1. And then we drifted back down to close slightly positive on the day. And things are pretty quiet in the initial overnight session as I go to record this, and it's likely to stay that way until we see the CPI release coming out at 8:30 a.m. Eastern. Still looking pretty good here with our intraday growth to value ratio, showing how the large cap growth is outperforming large cap value. And took a little bit of a hit here with our S&P growth to value ratio. We're still trying to look at the bigger picture here where we've been bouncing up overall, but Tuesday was not a good day for growth. In fact, it was down where value was up, and it was down more for the mid caps and down where small cap growth was up, or value was up. So taking a bit of a hit here with our growth to value ratios for the small caps, also coming down with the mid cap growth to value ratio, and a little bit here with the S&P growth to value ratio. And seeing a little bit of a decrease here in the ratio between the growth and value ETF. We're still at the higher end of the rainbow. And a little bit more of a hit where discretionary had been doing really well. It's kind of in the shorter term has not been performing as good as before. But when you look at the discretionary to staples ratio, it's still outperforming. State discretionary is outperforming here. And we declined a little bit, but we're still above the 50-day moving average with the large cap growth ETF. And here's the condition of our trend. The ADX, that's the black line. It just continues to go down. We're getting down to 10. So yeah, I think we're a little below 20 here, and we're below the moving average, and we don't see any signs of this turning up. And the green line and the red line are almost on top of each other. If you look over here, the green value is just a little bit higher than the red value. That's why we're still staying with positive and seeing that same thing here with the green value slightly over the red value for the short-term ADX, but still just not trending currently. And dropping off with volume as the lead up comes into CPI. And not much of a change here with the VIX, both with the line chart and the bar chart. Not much of a change with the VIX of the VIX either. And we're still kind of drifting lower, though, with the momentum of the VIX as measured by the MACD. Still getting a high reading with the skew index. We have not come down out of that red area yet. And we ticked up a little bit with this fear gauge, and we were down slightly with this other fear gauge. So not a lot of confirmation there. We went up with the equity put call ratio. This could be some hedging going on ahead of CPI coming out. So now we're ticking back up with the 5-day chart, and we're going down here, or back up with the 5-day chart here, and going down a little bit still with the 10-day chart. And volatility risk premium picking up a little bit, but still inside of this band here. Okay, so our advanced decline lines are still looking okay. Not really changing all that much. We're just kind of drifting sideways, but they are still positive. And we ticked up a little bit with the advanced miners decliners over the 10-day period, but we're still below zero. So this has turned negative after Monday session, and it remains negative, although improving after Tuesday. And still going down with the 5-day and the 10-day moving average of the new highs minus the new lows. Seeing a contraction of the new highs, a little bit of a contraction of the new lows here. And ticking up a little bit and still above zero with our advanced decline ratio, both short and intermediate term. This is smart money indicator number one. This is still looking positive, and it went back up, and it's above the advancing moving average. We're still going up with the red line with the chicken money flow, even though the histogram came down a little bit. This is the one that's concerning us, though. The chicken oscillator, it's just not really showing much improvement now and coming down after giving us a pretty high extreme reading. And the vortex is positive, but the green line's coming down as the red line's going up. And we look at our advanced decline line studies, still above the moving average with the NYSE common stock, S&P, and mid caps, trying to come back up, but still under the moving average with the small caps. And looking at those stocks in the S&P above their 20-period moving averages, ticked down just a little bit, but we're still above 50. Saw a bit of an improvement with those stocks above their 100-day moving average and the 50-day moving average and the 200-day moving average. It was more short term that we saw a little bit of weakness. Here's the daily chart. We are dropping below the moving average here with volume and just kind of meandering sideways right now. And some folks are pointing out that I haven't seen this, but they probably are, that we're creating some kind of a wedge or triangle here. And that usually produces some kind of a breakout once this gets dealt with. A little bit of an improvement with the 20, turning up barely with the 50, and pretty much flat to slightly declining with the 200 period moving averages on the S&P. Still below the midpoint with Stochk RSI, not showing any conviction there. Above the midpoint with the Williams percent R, no conviction. Above the midpoint with the CCI 14 and 20, but they just haven't been moving all that much lately. The stochastics, they're not extreme right now, either in the short term, intermediate short term, or the long short term. Did turn up just a little bit here. The force index is still positive since it's green and above zero. The condition of the short-term trend, we still pretty much continue to go sideways right now, but we're still above the simple and exponential moving averages. And we're above the midpoint with our standard deviations chart. The balance of power, still looking pretty solid here, above zero and now turning back up slightly. The go, no go is still positive with the dark blue bars, above the midpoint with our highest high value chart. But the TTM squeeze continues to go down with the darker blue bars. That's showing some weakness, or at least a lack of conviction to the upside. We're dropping below zero with the ease of movement. And we're still below zero with the McClellan oscillator for the S&P. We improved. We ticked up a little bit, but we are still negative since it's below zero. So we're starting to roll over now with the summation index based on price, and we've already been declining based on volume. We're just a little bit above zero with the McClellan oscillator for the NYSE, even though it ticked down slightly. So we're still going up here based on price. We're flat right now based on volume. The Erin indicator is flat, but still positive since the oscillator itself is above zero. This is where we're potentially seeing some improvement. The Swenlin trading oscillator, we're turning back up based on price and volume, and both are above zero. So this is actually positive right now. Momentum is really slowing down as well. We haven't quite crossed below the moving average here with the PMO, but we're starting to cross below the moving average based on price. We're right on top of the moving average based on volume. A little bit of an improvement, but just about at the midpoint with the PMOs that are rising. We're still declining with the buy signals and still barely going up here with the PMOs that are above zero. We're still positive though with the Elder's Impulse system for the S&P, and we're still seeing an inside day based on Friday. So Monday was an inside day on Friday, so was Tuesday, but just we're just chopping around in wait and see mode here. And the parabolic SAR is negative with the dots on top. We're turning negative now in the short term with the slope oscillator. We're no longer extreme. We're dropping back below the green line. And we're pretty much flat here with the MACD right on top of its moving average. So looking a little more negative with the slope, we're flat with the TSI, our two short-term momentum oscillators, and flat with our three intermediate term, rolling over but still positive with our long-term oscillators, negative with the Copic curve, and still hanging in there okay with the Sean trend meter. Still above 50 with the money flow and the ultimate oscillator. Still above the moving average with on-balance volume. And this indicator is why it matters whether it's an up day or a down day. This was developed, one of the first technical analysis indicators by Joseph Granville. And basically, uh, there's been better indicators since then, but a lot of indicators that we use are based off of on-balance volume. But if we have an up day, then the volume is counted as positive. If we have a down day, the volume is counted as negative. And that's why we continue to go up with this. And even though we had barely an up day, it still counts. All of the volume, according to this chart, is now positive. We're still above 50 with the RSI 14 and 9, and still going up slightly here with the intermediate term trend based on 50 periods. Still above the 50 period simple and exponential moving averages. Still above all the plotted moving averages here. And we came back up a little bit, but not really showing an awful lot of strength with the bullish percent index. It's getting choppy now as well. We were pretty much flat to slightly declining with the NYSE bullish percent index. And after coming up and giving us a reading, we're continuing to go down with the NASDAQ 100 bullish percent index. And we're watching this little mini rainbow here to see if these areas are acting as support if we continue to fall. But the rainbow is still going up. Longer term, still watching the upper end of this trend channel going back to 2009. And so far, it seems legitimate to say that this has been providing overhead resistance. And we're still seeing a lot of sideways action here with the Heiken Ashi chart. We're negative, but pointing up with the Kegi chart, where we're positive with the Renko chart and positive with the three-line break chart. Long term, just kind of chopping around right now with our 150 and 200 period moving averages. So we're negative in the short term with the mid caps and small caps. They had their little upward surge, and then they seem to be giving a lot of that back now. And bonds are still positive in the short term based on price, but still negative in the intermediate and long term. And we had healthcare and discretionary. Okay, healthcare is defensive, discretionary is more growth oriented. Those were the negative sectors. All of the other sectors ended up being positive, with staples, another defensive area, energy, another defensive area. These have been the areas that have been, at least they performed better in Tuesday's session. And nothing but red here. So you're seeing nothing but Valentine's Day, where we had an ETF for the healthcare sector, do a bearish MACD crossover. That's more defensive. The BPI crossed below 70 with the financials. Now, that's a stronger area, and we want to keep an eye on that one. And the NASDAQ crossed below 19.7 and then 19.6. Discretionary is also having a BPI cross below 50. So there was some negative technical analysis action in Tuesday's session. And the Dow's just kind of floundering sideways right now, still above its 50-day moving average, and it's still neutral with the Elder's Impulse system, still slightly above the moving average, the 50-period moving average here with the Nasdaq, even though it was down 1/3%, and still above the 50-period moving average with the Nasdaq 100, still positive with the QQQs, looking at the Elder's Impulse system. Momentum is just barely positive, but really trailing sideways currently. And here's the small caps. They were down enough here. There's just a little bit above this pivot point, but just cannot get above their 50-day moving average with the S&P 600 small cap index, and still below the 50-day moving average with the Russell 2000 small caps. And they've gone from negative to neutral back to negative again with the Elder's Impulse system. When looking at the small caps, trailing off and dropping below the pivot point here with the mid caps, and still negative with the Elder's Impulse system. The Wilshire, it was down slightly, but still above its 50-day moving average, as is the total U.S. stock ETF. Financial sector was actually up 1/4% here. So the weakness that we saw was earlier in the day, and then it picked up and showed some improvement later on. The FANG index was down slightly, but still looking pretty positive here. Apple was up over 2% between its 50 and 200-day moving averages. Amazon was virtually unchanged, still above its 50-day moving average. Microsoft is below its 200 period moving average. Google, little change, dropping a little further below its 50-day moving average. Meta was up 1/3%, still looking pretty solid here. Tesla really dropping off these days, down another 6 1/3%. Nvidia coming back up and hitting its 50-day moving average. Netflix was down 1.9% after setting an all-time high. And not really seeing much of a change in the short and long term when you compare the correlation between US and world stocks. Oil going back up now into the 73 range, but still at the lower end of the 70s where we've been at for quite a while. The dollar still hanging out above its 50-day moving average and still in an uptrend. And going back up above the 4.5% level with the 10-year yield. And here's the intraday chart that I've been following here. We gapped higher and just stayed there for the rest of the day. And looking at a little bit of a decline here with the 7 to 10-year Treasury bond ETF. This is a new chart. This is doing a ratio between inflation expectations, which I usually cover in the weekly video, and then TIPS, which are Treasury inflation protected securities. This is what folks get into when they're worried about inflation and interest rates going up. So if we see this ratio going up, that means the expectations for inflation are outperforming the TIPS, which do adjust for inflation and rising interest rates. And that's what we saw after the whole COVID crash and everything. This really started to shoot back up, coming back down, not seeing much of a change right now. So I usually show a weekly chart of the inflation expectations, and then I go through this in the weekend videos that I do with some other ratios looking at TIPS to other bonds. We're keeping an eye on a rising 10-year yield in Japan. This continues to go up, which could cause a problem. It caused a problem last summer. We're seeing if it's going to cause a problem soon. And still looking okay here with the Qs to S&P ratio. Where we're really dropping off is discretionary to the S&P. And not much of a change here with large cap growth to value, looking at that ratio. So with the large caps, still below the moving average here, coming back down with the mid caps and dropping below the moving average with the small cap growth to value ratio. So what's our outlook? We're positive, but we're really lacking conviction right now, and we're not trending. We're going to get the MBA Mortgage Applications Index, CPI. That's the biggie. And then all the different geopolitical things going on to see if they have any kind of an impact right now. Then on Thursday, we're going to get PPI, and then Friday is going to get retail sales released. Here is what we're looking at for Wednesday, and then what the previous readings were here for PPI coming out on Thursday. Seasonality, not much of an edge here. A little bit to the positive side for the Dow, S&P, and NASDAQ for February 12th. We're still dealing with the first half of February. That tends to perform better than the second half of February. And then February, it's the worst year in a post-election year. And here's the first half of February versus the second half of February. This is also showing how February doesn't perform well in a post-election year. Then this is a newer chart put out by Stock Traders Almanac. The takeaway from this is what I cover back on the seasonality slide, where basically it just says if January is good, the rest of the year tends to be good as well. And that's kind of the takeaway. Whether you include the 11 months after January or you take all 12 months together. That's what they're trying to measure up here. So we're still negative with the parabolic SAR. We're negative with the S&P McClellan oscillator. So that means our summation indexes are now turning down. The Copic curve is negative. Ease of movement is negative. But then on the positive side, we're concerned about the Chaikin oscillator. It's negative, but we're seeing the other two smart money indicators holding up fairly well. The growth to value ratios, they got hit on Tuesday, but the longer term trend is still positive. And let's see, I should have changed this. The 5-day chart is going up, which would be more negative. The 10-day chart is going down. So we're getting another mix there. The advanced decline line studies are positive, but not showing any real convicted strength right now. And we're still slightly above zero with the NYSE McClellan Oscillator and Summation Index. And our momentum has really been weakening. The short term, kind of flat to down, intermediate term, rolling over, also looking flat. We're still positive, but rolling over in the long term. The bullish percent indexes, they're still positive since they're above 50, but not seeing a lot of conviction in Tuesday's session. The vortex is positive. The Swenlin trading oscillator, if there was anything kind of positive developing right now, it could be this. But the reason this is yellow is I don't count this as a primary indicator because it does give us some false signals at times. The money flow and the ultimate oscillator are still positive. Our moving average studies positive, but not really changing all that much. And the financial sector is still positive, as well as just flat to slightly up with the NASDAQ 100 momentum. So our conclusion, we're positive, we're not trending. The smart money indicators I'm counting as mixed right now because of the Chaikin oscillator. And that's what we're seeing in the short term. Intermediate term, we are still positive, but we're just not trending, and we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.